Risk versus return. The risk-return trade-off is a fundamental investing principle stating that higher potential returns are associated with higher risk, and therefore potential for loss, while lower risk investments offer lower, more stable returns. Risk represents the uncertainty or volatility of an investment's outcome, while return is the profit or loss generated. Let's consider some of the key aspects of risk versus return. First, the trade-off. Investors generally demand higher returns to compensate for taking on higher risks. There is no guarantee that taking more risk will yield in higher returns. It only increases the potential for them. Low risk equals low return. Investments like savings accounts, guaranteed investment certificates, known as GICs, and government bonds have low risk and therefore low stable returns. High risk equals high return. Assets such as stocks, real estate, or startup investments offer higher potential for growth, but carry significant risks of capital loss. Measuring risk. Tools to assess risk include alpha, which is performance versus benchmark, beta, volatility versus market, and the Sharpe ratio, which is a risk-adjusted return. Let's consider the factors influencing risk. Time horizon, investment quality, market conditions, investor behavior. These all affect the risk-return profile. So let's talk about managing the trade-off. First, diversification. Spreading investments across different asset classes, stocks, bonds, real estate, helps lower overall portfolio risk because different assets perform well at different times. Time horizon. A longer investment time frame generally allows investors to take on more risk as they have more time to recover from short-term market downturns. And risk tolerance. This is an individual's emotional and financial ability to handle fluctuations. Factors like age, income, and goals determine the appropriate balance. Want to learn how to construct a dynamic financial fortress? Contact us at portfolio.wealthnation.ca.